Good morning to all. On behalf of Zentax Clinic, I welcome you all for this edition of the webinar. It is your continued patronage and then your continued participation in all the webinars organized by us is a strength behind this continuous performance of the webinar by the Zentax Talks. So last week, Arvind Tangam discussed about the rate of changes brought about in the 56th GST Council meeting. This decisions taken at this 56th GST Council is called, or colloquially we are referring it to 2.0 or 2.0, but the recommendations in the press note refers it as next generation GST reforms. So GST itself, first it's a reform. Now it is called a next generation GST reforms. Last week, the discussion was mainly about the rate of changes with regard to goods. But there are changes in the rate of tax for services also. So what are the changes in the rates of tax for services? These are all the aspects that are going to be dealt with by our team member and expert CA Divya Prabha. She is a very expert speaker and also very good subject knowledge speaker. So she will be explaining you about what are the changes that has come with regard to the services. Not only that, so everybody is interested in the pre-budget, in the pre-GST era or during the central excise era, people used to be wondered, okay, will there be any rate of reduction in the for the goods that are going to be consumed by me, or that rate of any change in the goods of common man use? So that was the main intention of the common people. So in this 56th also, the common people has been brought into the focus, and then there is a great reduction in the rate of tax for the goods dealt with by the common man, like soap, paste and everything. In addition to that, there are some proposed changes in the law and also some proposed changes in the legal requirements. So that also will be dealt with by Divya Prabha today. So what are the main changes with regard to the procedure or law? So the first one is they are going to bring about a simplification in registration. You will be aware of the fact, after this fake ITC claims, the registration has become a very tough. The department is giving the physical verification and then other authentication. So personal visit by the officers, all these measures are undertaken to curtail the menace of bogus ITC claims. So in this background, getting the registration became very difficult. So even many people aired their views or grievances in the public forum like Twitter, or now it is called X. So for that also, the finance minister responded, it will be simplified. And then instructions were given for simplification of the registration. Okay. So what are that? Do not ask for the details other than what is mentioned in the application form or in the rules. So you do not ask for much of the details. Now, another scheme for ease of registration has come. But this will be verification, subject to verification. And then this person should not make a B2B invoice transferring ITC more than 2.5 lakhs per month. So if these persons are going to apply, then it will be given shortly. So within a very short period of 3 days, they will be getting the registration. This is a new scheme of registration. So it will be opt-in and opt-out. So this type of simplification is done. And also, then what are the other issues? Then there is a credit note issue. Whenever a discount is given, particularly post-sale discount, whenever the post-sale discount is given, there is always a problem whether we can reduce the output tax. And then one of the conditions stipulated was the recipient of the credit note should have reversed the ITC. And then there should be a pre-existing agreement. All these issues created problems with the department and also assist. So they were not able to reverse ITC, the supplier, then reversal by the recipient, how it has to be verified. Then there was a circular was given. So they can voluntarily say they have reversed the ITC. This will enable the supplier to reverse the output tax already paid by him. And if the amount exceeds 5 lakhs, then they have to get a chartered accountant certificate. This circular is going to be rescinded. This circular is going to be rescinded, and then it will go out of that will become outdated, and then they are going to introduce a new scheme or new method by which only when there is a reversal by the reversal of ITC by the recipient, the supplier will be able to reduce his output liability. So there is going to be a new scheme is going to be done. Then in addition to that, inverted duty structure, government is trying its best to avoid the inverted duty structure, but still, even after the proposed amendment, there are some goods that will fall under the inverted duty structure. So inverted duty structure, now there is a concept called provisional refund. So 90% of the amount has to be paid immediately or within a period of 7 days. So this does not cover the inverted duty structure. This severely affected the cash flow of the person who are opting for the inverted duty structure, or who has got a not opting, who has got the inverted duty structure. So these persons who have got the inverted duty structure, they have to approach the government, and then they have to convince the department, and then they have to get back the refund. It took some more time, and you will be knowing that there are issues in getting the refund from the department. To avoid that, this provisional refund, which is available now for zero-rated supplies means exports. Now it is going to be extended to inverted duty structure also. So they will be getting 90% of the refund amount applied on a provisional basis. So this is one of the welcome measure that is undertaken by going to be undertaken by the department in the future. So these are all some of the areas that has to be brought to the knowledge of the audience as such. For this purpose only, we are conducting this second portion of the 56th GST Council. Then what are the deliberated? Now all these amendments will become part of the act or law, or only on the issue of the relevant notifications. Till the notification, but the trade and industry should take all the measures to be ready for the change. Because suppose the change is going to be coming in from 22nd. Now they are going to issue the notification, say, in 20th, then it will be very, very difficult for the trade and industry to understand. So based on this, till at the time, what should be done by the industry as such? For this purpose, we thought on the basis of the what are the deliberated in the GST Council, 56 GST Council, we shall bring it to the knowledge of our audience. So with this, we thought we will be bringing all the changes. The first portion was dealt with last week. This week, all the other changes will be dealt with by Divya Prabha, Chartered Accountant. Now it is over to Divya Prabha, Chartered Accountant, to elaborate you what are the other changes that have taken place. Now it is over to Divya Prabha. Thank you.
Morning, everybody. So please let me know if my audio and video are clear. If it's not clear, please kindly put in the chat box. And also, please let me know if the PPT is visible for all of you. Yeah, okay, let's start the session. So good morning, everybody. It's great to see you all for our webinar 89th session of Zen Tax Talks on a Saturday morning. We usually have our sessions on Friday afternoon, but due to some last minute changes, we plan to have this session on Saturday morning. Anyways, thanks a lot for attending the webinar and always showing a support to us for every week's webinar. So as CA Paul Thangam sir had introduced the session, this is a follow-up or a continuation session of the last week's analysis of 56th GST Council decisions, part 1. So we all know very well that this has been the most talked about, trended or discussed topic for the past 7 days. In fact, for the past few days. And we were one of the very few to come up with the session immediately after the GST Council meet on 5th September 2025 by our CEO, CA Arvind Thangam sir. So we had discussed in detail on many issues faced by the trade and industry in our first session. So if you've missed the first session, make sure to check it out on our YouTube channel. And today we thought we'll discuss the remaining parts of the council meeting. That is, we had discussed the goods sector, changes in rates in goods sector in detail in the last session. In this session, we'll be talking about the services sector and other trade facilitation measures brought in by the recommendations of the GST Council meeting. So let's, without further ado, let's get into the session. So yes, so sir had clearly mentioned that despite us getting all these announcements and recommendations of the GST Council, it will only be considered final or relevant when the same is given effect through a relevant circular, notification or amendment to the law. Therefore, the recommendations of the GST Council have been presented very clearly in the press release. However, this has to be given effect through notifications, circulars or the amendments. Now, in the 56th GST Council meeting, what has happened? See, I think we are moving towards achieving the objective of introduction of GST. GST, that is the goods and service tax, the aim has always been to make it a good and simple tax. Have we achieved it? Not yet, but are we on a path to achieve it? I think so, because we've had 4 rates till now. 4 rates, that is 5%, 12%, 18%, and 28%. Currently, the council meeting has recommended only to reduce 4 rates into 2 rates, that is to have only 5% and 18%. Therefore, I think we are moving towards a better system of GST. And in fact, we can even expect in future years or even coming months that the rate could be simplified into just one simple tax rate. Therefore, in this council meeting, various rate changes have been made in both with respect to both goods and services. Additionally, there were many facilitation measures, like to make businesses more easier. Some measures were introduced, like a registration for small level taxpayers, refunds, provisional refunds for low inverted duty structure and zero rated supplies, and issuance, clarification on issuance of post-sale discounts, that is credit notes issued for post-sale discounts. And we've also got a small announcement regarding the operationalization of GST Appellate Tribunal. And on the same day, we had also received a FAQ, a list of 70 plus questions on some doubts that could arise due to the recommendations of the GST Council meeting. Let's cover it one by one. With respect to rates changes, in the last session, we had talked in detail about the rate changes in goods sectors. Does not mean we will not talk about goods today. We'll very briefly touch upon goods. Today, we'll concentrate on the rate changes in the service sector. So if you look at service sectors, the rate changes have happened in the following sectors. That is the transportation sector, job work sector, construction sector, local delivery sector, some other services, and few of the services have been moved from 28% to 40%, and 2 services have been proposed to be exempted. Now let's look at transportation sector. In transportation sector, these are the few important rate changes that have taken place. The first one is supply of air transport of passengers in other than economy classes. Let's say for passengers who are traveling in premium classes like business or first class, initially the ITC, the rate was 12% with ITC, but currently it is 18% with ITC. Two things have to be looked at here. This rate change could lead to decrease in demand, that is discretionary demand for the premium class travel. So the airline companies could face an issue with the occupancy of the premium classes. But the second thing that we can also analyze from this is that 18% with ITC means the companies could use this ITC to offset their outward supply. That is, this ITC 18% tax could be used to offset the accumulated ITC till date. The next rate change has happened in supply of passenger transport by any motor vehicle where fuel cost is included. Initially, there were two rates for this service. That is a concessional rate of 5% with ITC of input services in the same line of business. And there is no change in this GST Council meet for the same rate. Now, for the 12% with ITC category alone, the rate has been increased to 18% with ITC. And the next entry is supply of transport of goods in containers by rail by any person other than Indian Railways. It was initially 12% without with ITC. Currently, there are two rates. That is, one is 5% without ITC and 18% with ITC. And the next is supply of transportation of natural gas, petroleum crude, motor spirit, high-speed diesel or ATF through pipeline. And there are two changes, just like supply of passenger transport. 5% without ITC, there is no change right now. 12% with ITC, there is a change of 18%. And next comes the important change, that is supply of transport of goods by GTA. Initially, we had two rates, 5% without ITC under RCM or FCM and 12% with ITC. Now this 5% without ITC, there is no change right now. But this 12% with ITC, there is an increase in tax rate. That is, it has become 18% with ITC. Now from this table, let's discuss for all the tax rates that have reduced, there are two impacts. One is the cost for the end consumer could be lower. But also at the same time, if the respective input services used by these services are higher, it could lead to inverted duty structure, huge accumulation of ITC. And if the ITC cost is not, the businesses are not able to set it off with their output tax to recover such ITC cost, the price can also be increased. Now, when it comes to increase in tax, in these tax rates, the impact could be we will have to look at the additional inputs or the input services used by these services. What are the tax rates, and will this increase in the tax rates lead to increase in prices for the end consumer? Let's take for GTA. Any industry uses the services of GTA. So this could lead to increase in the cost of such industry. Let's take for textile industry, for any industry, FMCG industry, they use the services of GTA to transport their goods. While lots of FMCG and the textile industry rates have reduced to 5%, the increase in the rates of GTA to 18% will lead to huge accumulation of ITC and will lead to huge balance under the inverted duty structure. This cost will need this increase in the ITC accumulation will need to be addressed by the government in the coming days. So these services, these service providers, while also there is a rate change for their output supply, they should also consider what happens to their inputs and input services. Therefore, for these, since this is a transport sector, they will also have to look at their ITC eligibility under section 17 subsection 5, which says, notwithstanding anything contained in subsection 1 of section 16 and subsection 1 of section 18, ITC shall not be available in respect of the following, namely motor vehicles for transportation of persons having approved seating capacity of not more than 13 persons, except when they are used for further supply of such motor vehicles, transportation of passengers, imparting training on driving such motor vehicles. So the service providers who have had a rate change recommendation by the GST Council meet will also have to look at the implications of the ITC eligibility for their inputs and input services as per the provisions of the GST Act. Now that we've discussed the service section of the transportation sector, let's move to the automobile sector. So these are the important changes that have taken place in the automobile sector. We can see clearly that automobiles running on petrols and petrol hybrid, LPG, CNG cars not exceeding 1200 cc and 4000 mm length, the rates have been reduced from 28% to 18%, and the same goes for diesel and diesel hybrid cars, three-wheeled vehicles, motorcycles not exceeding 350 cc, motor vehicles for transport of goods, and other motor vehicle parts. So here we'll have to look at additionally the petrol and petrol hybrid LPG CNG cars exceeding 1200 cc and 4000 mm length, their rates have been increased from 28% to 40%. We'll look at the significance of 40% in the upcoming slides. But currently for this automobile sector, though it promises to increase the consumption for the automobile sector, there are other advantages such as this rate changes recommendations by the GST Council meeting has given clarifications with respect to various classification of automobiles. And the next thing is this reduction in rate could boost up the consumption expected, and also for the end consumer, the reduction in the GST rate of the parts and parts of the motor vehicles will also lead to reduction in cost of servicing their vehicles. So therefore, while this proves to be advantageous, there are also challenges like in the EV sector. If you look at the press release which had the rate changes in a detailed manner, if you look at the EV sector, the inputs are often in higher rates than the outputs, which will lead to ITC accumulation. So there are clarifications still required for many rate changes recommended by the GST Council. And next is tractors. So moving to agricultural sector, tractors and tractor parts and accessories, the rates have been decreased from 18% to 5%, which is a very welcome move considering the agricultural sector spending capabilities. Now moving to another important sector, that is the job work sector. So the first four entries are supply by services by job work in relation to umbrella, in relation to bricks, in relation to services, other services, which are from 12% with ITC to 5% with ITC. These are very minor, minimal impactful changes. However, coming to the last entry, that is supply of job work not elsewhere covered. So all other job work services have been increased from 12% to 18% with ITC. Now this means some sectors which are heavily dependent on job work, that is they have multiple processes and multiple job work processes are undertaken in their products, their cost is going to increase from 12% with ITC to 18% with ITC. Let's take, for example, textile sectors, which will have lots of job work processes undertaken. For them, due to their outward supply rates have been decreased to 5%, lots of outward supply rates. But then the inward supply rates have been increased to 18%, which would in turn lead to ITC accumulation, and the issue of inverted duty structure will still remain for them. While the aim of reducing the tax rates for textile sector was to reduce the burden of inverted duty structure, this does not this only adds to the burden of sectors which are heavily dependent on job work. And as we also saw for GTA also, the rates were increased. So GTA, job work, all these kind of services are very common in most of the sectors. And another reason is the inverted duty structure. Refund on inverted duty structure is allowed only on inputs. When we look at Rule 89 Sub Rule 5, it says, in the case of refund on account of inverted duty structure, it shall be granted as per the following formula. And the formula suggests term called net ITC. And net ITC shall mean input tax credit availed on inputs during the relevant period. It does not include input services. So what does this mean? For all those services, job work services and the GTA services that the sectors are using, and their in turn their output services, rate of tax on output services have also been decreased. What will happen to these increase in cost on inward services? They will have to be written off as expenses, or what mostly would happen is this increase in cost of inward supply would only be passed on to the customer, to the end consumer, by an increase in the prices to offset the input cost. Therefore, this has to be addressed in the upcoming circulars or notifications by the government. This is with respect to the job work sector. Going to the construction sector, we've had some significant announcements. So the composite, the first three entries deals with increase in rates from 12% with ITC to 18% with ITC. So composite supply of works contract and associated services in respect of offshore works contract relating to oil and gas exploration and production in offshore area. And the next one is composite supply of works contract involving predominantly earthwork like excavation, site mining, etc., provided to the government. And the next one is also subcontract of the subcontract services to the main contract of the above service. So all these are the rates have on all these composite supply has increased to 18%. However, when you look at the input inward inputs for the construction sector, that is sand, lime, bricks, stone, inlay work, the rates have reduced from 12% to 5%. And when you look at some cements like Portland cement, aluminum cement, and other cements, the input, the ITC, the tax rate has reduced from 28% to 18%. Will there be significant decrease in price for the end consumer in their, let's say, the square feet rate? No, there won't be significant reductions, but maybe around, let's say, for around 100 rupee per square feet, changes up to that limit can be expected. So while services provided to government, the ITC, the tax rate has increased. The inputs used for construction sector, the tax rate has reduced, which is a very welcome change. Moving to the next services in which rate change has happened is local delivery services. So local delivery services have initially been 18% with GST, and it still remains at 18% with GST. There are no changes. But the supply of local delivery services through e-commerce operators. Now, this is a huge and massive industry because anything and everything, people are reaching out to e-commerce operators right now. That is, anything you want, you go to Amazon, you go to Blinkit, you go to Zepto, and it covers almost whole of the requirements of the consumers. Therefore, this bringing it tax on local delivery services through e-commerce operators would boost up the revenue to the government. However, this is yet to be notified under section 9(5). So what is section 9 subsection 5? 9 subsection 5 is the government may, on the recommendations of the council by notification, can specify category of services on which the e-commerce operator should pay tax as if they had supplied such services. So in the case of delivery, local delivery services, the e-commerce operator will undertake to pay tax on the local delivery services at the rate of 18%. See, you might get a question as to transportation of goods by road is exempt, right? However, if you look at the notification, exemption notification of 12/2017, transportation of goods by road is exempt except GTA services and courier services. So these local delivery services are covered under GTA services. And if the supply of local delivery services through e-commerce operator is to be taxed at 18%, two things will have to happen. It will have to be removed from the GTA service scope of GTA services. And the second thing is it will have to be notified through section 9 subsection 5 of the GST Act. Therefore, this is one massive industry covered by the GST Council recommendation. Moving on to some other services. Other services like supply of service of third-party insurance of goods carriage. It has gone from 12% with ITC to 5% with ITC. And the services by way of admission to exhibition of cinematograph films where price of admission ticket is 100 rupees or less, it has gone from 12 to 5% with ITC. And then treatment or disposal of biomedical waste has also gone from 12% with ITC to 5% with ITC. The next important change is supply of hotel accommodation having value of supply of a unit of accommodation less than or equal to 7,500 rupees per unit per day or equivalent has gone from 12% with ITC to 5% without ITC. The first thought that comes to our mind is, okay, hotel accommodation, the rate accommodation, if the value of supply for a unit of accommodation is less than 7,500, the rate of tax is going down, so the end consumer will only benefit, right? However, it has to be looked at from the industry's point of view. Initially, it was 12% with ITC. Now it's 5% without ITC. Even though there is a 7% benefit to the consumer, the restriction comes with the word without ITC. That is, the ITC cycle is broken here. The hotels will not be able to claim ITC for rooms which are supplied for less than 7,500 per day. Now, what will they do? They'll have their inputs and input services. Let's say for other they use other services of housekeeping or some other services, and they have ITC on the same. How do they set off this ITC? By just charging 5% without ITC. The hotels will have to now carefully plan as to and see what is their cost. If their cost comes around 2 to 3%, they can very well set it off. The end consumer can still end up with a benefit of 4%. But if the cost is more than the 7% that is being reduced due to this rate change, the hotels will have to plan their price, and I think they have to slightly increase the price and charge to the customers to cover the irrecoverable cost of inputs used for such rooms. The next services by way of treatment of effluents by a common effluent treatment plan, and this has gone from 12% with ITC to 5% with ITC. And the other next three entries are other professional, technical and business services relating to exploration, mining or drilling of petroleum, crude and natural gas, support services for the above, and beauty and physical well-being services falling under group 99972. The last entry alone, it has the same thing as the hotel accommodation has happened with this, that is 12% with ITC has gone to 5% without ITC. Now the next category is some of the services have gone from 28% to 40%. Such as admissions to casinos, race clubs, any place having casinos or race clubs or sporting events like the IPL, the entry is from 28% with ITC to 40% with ITC right now. And services by a race club for licensing of bookmakers in such clubs, 28% with ITC to 40% with ITC. And one thing to be noted, the important entry is leasing or rental services without operator of goods, which will attract 40% GST, like machineries, plant and machineries that are given out on lease without operators. These are now taxed at 40% with ITC. Initially, it was 28% with ITC. So there is an increase in cost to the end consumer. And then specified actionable claims, also there is an increase in tax rate to 40% with ITC. So corresponding changes in the lottery valuation will also be undertaken to give effect to these rate changes. And now this 28% to 40% change, what is so significant about this 40%? Why is it called the special rate? Well, the FAQ issued by the by the government has addressed this question. And the FAQ number 38 says, why is a 40% rate referred to as a special rate? What is the basis for subjecting goods to a special rate? So this special rate is only applicable on few select goods, that is some sin goods or luxury goods. Initially, these sin goods or luxury goods, they attracted GST as well as compensation cess. So GST at the rate of 28% would have been charged on those goods, and compensation cess would have been collected on the same. And right now, compensation cess is going to the government has decided to end the compensation cess levy, and bring it under and merge it with GST and bring it under single rate of 40%. Therefore, this special rate has been applied to goods which were to services or goods which were already attracting highest GST rate. So this is the significance behind this 40% special rate. Now, there are two services proposed to be exempted in this recommendation. All individual health insurance along with reinsurance thereof, all individual life insurance along with reinsurance thereof. So it has gone from 18% with ITC to exemption. So in this, there are two things that have to be noted. One is only individual health insurance and life insurance has been exempted. So companies going for group insurance plans and other insurance schemes or policies will not be benefited from this, and there won't be any cost benefit for the businesses when we consider the businesses. But when you consider a common man, this is a welcome move. And the second thing is, these insurance companies which highly depend on individual insurances, they will obviously have inputs and input services on which they would have ITC. Now, since their goods have become, their insurance services have become exempt, individual health insurance and life insurance have become exempt, they will only try to recover the ITC cost by charging it in the price of the consumers. So that will also have to be looked at as to how the practical implementation happens. This is with respect to insurance services. And another announcement or recommendation in the GST Council meeting was with regards to restaurant services and outdoor catering. So now currently the specified premises definition, if you look at it, it says any accommodation or unit can declare itself to be a specified premise. But then this explanation proposes that specified premise definition can be changed so that the standalone restaurants cannot declare themselves specified premises, and only such hotels or accommodations whose accommodation value exceeds 7,500 per unit per day at any for any of the day throughout the year can declare it to be a specified premise and have the option to charge 18% with ITC. However, these other standalone restaurants only have the option to charge GST at 5% without ITC. So this is also a welcome move, but this rate change will have to be specifically looked at by consumers every time, at least for the initial few days when they go out to these standalone restaurants. So this is with respect to the service sector rate changes. Moving on to some of the goods sector, which have already been discussed in previous last week, but just going through them briefly. For the FMCG sector, you can see for all the basic items, that is the common man items, you can see a huge rate reduction. That is for be it paneer, paratha, etc. The rates have gone down from 5% to 18% to 0. And for cheese, it has gone down from 12% to 5%. For toothpaste, talcum powder, hair oil, shampoo, condensed milk, it has gone from 18 or 12% to 5%. So the common man items, it's either not taxed at all or taxed at the lowest percentage. But this industry will have to bear the burden of the increase in the GST rates of the job work industry and the GTA industry until a specific clarification or notification is issued in this behalf. Now, going towards textile sector, the main objective to change the rates behind the textile sector were to address the a huge ITC accumulation due to the inverted duty structures and the push towards the fiber concentrated inputs. So this recommendation has concentrated on reducing the rates on so many inputs as well as the accessories, apparels. And one welcome move is articles of apparel and clothing accessories of sale value not exceeding 2,500 per piece. It has gone from 12% to 5%. So what can this mean for the end user? It increases their consumption in the apparels below 2,500 per piece. But what does it mean for the domestic luxury apparel brands or luxury clothing? While the majority of the textile sector is apparels, less than 2,500 per piece is what is demanded in majority in our country. But if we look at exports or the domestic luxury market, articles of apparel and clothing accessories of sale value exceeding 2,500 per piece has been increased to 18%. Now this has an issue because it makes us less competitive in international markets, and the exporters are likely to get affected. Given the current scenario with the US tariffs, this is likely to hit the already burdened textile sector. So we'll have to see if any kind of concessions are provided on this in the forthcoming days. Moving to pharmaceutical sector, most of the common man medicines, most of the medicines used by the patients have been reduced to 5%, which leads to cost reduction for all those patients. And even if you look at the medical kits or the inputs used by the hospitals and clinics, the cost has come down due to the rate of tax being reduced to 5%. Now, this has two advantages in terms of refund, because see, they had huge ITC accumulation, and under the inverted duty structure, there were too much time gaps to provide refund, blocking their working capital requirements. And yes, their working capital requirements are also reducing due to the reduction of this pharmaceutical sector, reduction of rates in the pharmaceutical sector, because they're very capital intensive sectors. They rely very heavily on capital goods and machineries for their outward supplies. So this is another welcome move from the recommendations of the GST Council meeting. Next is the agriculture sector, which is the backbone of our country. So there are lots of almost all of the required inputs and input services in regards to agriculture sector has also come down. For example, diesel engines, agriculture machinery for soil preparation or cultivation, harvesting or threshing machinery, composting machines, and also the fertilizers and pesticide inputs have also come down to 5%. This will lead to an overall blanket rate reduction for the agricultural sector and the end consumer, that is the farmer who's using all these inputs and input services in their agriculture. So this is one sector which has had a rate reduction. And the next one is the paper sector. It is important to look at paper sector because almost all of the industries depend on the paper sector for their packaging needs. So if you look at the paper sector, while the inputs, medical wood pulp, chemical wood pulp, while the inputs rates have been reduced from 12% to 5%, the output rate, that is the paper, uncoated paper, and have gone up from 12% to 18%. So this leads to increase in tax rate of the outward supply, but decrease in tax rate of the input supply. So this will have to, we will have to see how this affects the packaging industry and how it leads to the increase in price in other sectors also, which depends mainly on packaging industry. This is the last sector which we are discussing for today. Now, what are the dates of implementation for changes in services? Rate changes in services. The implementation date is 22nd September 2025. For goods, also the rates will be implemented with effect from 22nd September 2025, except for these items such as pan masala, gudka, and all these sin goods. It will be at a later date till the loan and interest payment obligations under the compensation cess account are discharged. That could most probably be by the end of this year, December 2025, but we'll have to wait for further announcements. Now, what is the announcement with respect to Appellate Tribunal, which was made in the council meeting is, the GST Appellate Tribunal will be made operational for accepting appeals before the end of September and will commence hearing before the end of December. Therefore, if anybody has appeals pending, that is, they are going to prefer second appeal, and if they have their appeals pending, they can start filing from the end of September, and the hearing will soon commence from the before the end of December. And if at all since the GST 80 is being introduced so late in time, if at all there are lots of backlog of appeals, lots of pending appeals from many previous years, the date recommended for the last date to file such appeals is 30th June 2026. Also, the principal bench of GST 80 will be the national appellate, will also be the national appellate authority for advance ruling. So now this this is looked at, this has been this will be useful in helping helping in solving the disputes sooner, and also to provide clarification on the advance ruling issues which are long pending before the appellate authorities. Now, as I started the session by saying, with the rate changes, there are also measures introduced for trade facilitation, like refunds at a faster rate, simplified refunds, simplified registration schemes, change in place of supply for intermediary services, and changes, amendments in sections 15 and 34. Let's look at it one by one. The first one is refunds for zero-rated supply of goods or services, or both. So zero-rated supply of goods or services or both means exports or supply to SEZ. Now the rule amendment to Rule 91 Sub-Rule 2 of CGST rule is being made to provide that initially it was in such a way that these refunds, when you apply on zero-rated supplies, the proper officer will have to manually verify and scrutinize all these refunds and grant you your refund claim. However, right now, if this recommendation is agreed, this refund will be, the 90% provisional refund will be sanctioned based on the identification and evaluation of risk by the system, not by the proper officer. In very exceptional cases where the reasons are to be recorded in writing, the proper officer can undertake manual and detailed scrutiny of the refund claim and then grant a refund. So usually it is going to be in a way that whenever you apply refund within a short period of time, based on the evaluation by the system, you will be able to get your refunds, at least your provisional refunds, at a much faster pace than what is being undertaken right now. But one thing is to be noticed here is that we will have to see the efficiency of the system, the IT infrastructure, and also the transparency of the risk evaluation schemes that is being put into place. And only based on these two can we will be able to comment if this refund will be effective and efficient for the industry as a whole. Now, the category of persons who are not eligible for this refund will be notified on a later date, and this provisional refund of 90% at a faster pace based on the evaluation of the system will be operationalized from 1st November 2025. In similar lines to refunds on zero-rated supplies, we also have for refunds on inverted duty structure. So the council meeting recommended that Section 54, subsection 6 of the CGST Act can be amended to say that 90% of the refund claimed as provisional refunds can be provided by the identification and evaluation of risk based on the system. And the CBIC is to issue instructions to tax field formations for the grant of provisional refund equivalent to 90% before the operationalization of this refund scheme, that is before 1st November 2025. So as I said earlier, for zero-rated supplies, the effectiveness of this refund on the IDS, inverted duty structure, will only be known when we get to know what is the risk evaluation schemes that is being put by the system, and how efficient is the system in tracking and providing refund instantly on application. So these are with respect to refund. No, we have another recommendation with respect to refund, that is refunds in respect of low value exports. So initially, Section 54, subsection 14 of the CGST Act read as, notwithstanding anything contained in this section, no refund under subsection 5 or subsection 6 shall be paid to an applicant if the amount is less than 1,000 rupees. So this affected lots of small exporters who exported through courier or postal modes. However, this threshold limit will be has been recommended to be removed in this council meeting, so which will help small exporters to explore more and boost the export of the country. Now, to make doing business easier in the country, the recommendations of the council meeting have come up with 2 simplified GST registrations. One is for small businesses. So this is an optional scheme, that is the taxpayer, that is the registrant can opt for it and can also withdraw from it voluntarily. And this registration will be provided within 3 working days from the date of submission of application of low risk applicants, and applicants based on their own assessment are saying that their B2B supplies, outward supplies per month will not exceed 2.5 lakhs. So here we have to wait and see who are low risk applicants, and what is the mechanism to opt in or opt out once this value of B2B supply exceeds 2.5 lakhs per month. And this 2.5 lakhs per month should be inclusive of GST. Therefore, their B2B supplies per month, including GST, should be less than 2.5 per month. And this is set to benefit 96% of new applicants and will be operationalized from 1st November 2025. Now, the next simplified scheme for registration has been brought for small suppliers supplying through e-commerce operators. As we all know, Section 24 says suppliers supplying through e-commerce operators are required to compulsorily register under GST Act. And Section 22 says any supplier supplying from any state is required to register. So these suppliers supplying their outward supplies through the e-commerce operator in various states are currently required to register in multiple states to show their principal place of business under each of the state. Now, this simplified GST registration recommendation from the council has approved the concept. It has not yet recommended that this be brought in. It has approved the concept of simplified registration for all small suppliers making supplies through e-commerce across multiple states. And the detailed technicalities are yet to be placed before the GST Council. So this can be expected in the next council meeting or in the forthcoming days. Now, another important recommendation in the GST Council meeting was with regards to intermediary services. So intermediary services was covered under Section 13, subsection 8, clause B of IGST Act, where it said, the place of supply of the following services shall be the location of the supplier of services. So the Indian intermediary service provider, whenever they were providing services to recipients outside India, due to this particular provision, they were denied the benefits of exports. That is, they faced they could not claim refunds under exports, and it was meant as if they were intra-state supplier. That is, they had to pay CGST, SGST on their supplies. It was treated as domestic supplies, and they also faced competitive disadvantages compared to international markets. Now, this move in this recommendation, it is said that the place of supply for intermediary services will be as per the default provision of place of supply. That is Section 13, subsection 2, which says the location of the recipient of such services. So right now, an intermediary, Indian intermediary service supplier, when he's supplying his services to a recipient abroad, can claim the benefits of zero-rated supply of services. Therefore, their competitive advantage has increased due to reduction in cost due to GST export benefits, where he does not have to pay GST. So yes, as I said, to help Indian exporters claim export benefits, place of supply for intermediary services have been changed, which is a very welcome move. Now, another important point of discussion is post-sale discounts. So currently, as per Section 15, subsection 3, clause B, subclause 1 of the CGST Act, it is important to establish the discount, post-sale discount, in terms of agreement before or at the time of supply, and that post-sale discount should be linked to a specific invoice. Therefore, even genuine post-sale discounts which were provided due to evolving market conditions were not the recipients or the suppliers were not able to claim the benefit of post-sale discount. That is, the transaction value could not be reduced because of such post-sale discounts. Now, with the introduction of this recommendation, the sections of 15 and 34 will be amended to provide that discount should be granted through a credit note issued under section 34. And what will section 34 say? It will say any post-sale discount credit note issued on the credit note, ITC will have to be reduced by the recipient and the value of supply can be reduced by the GST credit note for the supplier. So it means a transaction value can be reduced for a post-sale discount under section 15 if the credit note is issued as per section 34 and ITC is reversed by the recipient. Now, circular number 212 spoke about the mechanisms to comply with the current section 15(3)(b), and the council has recommended to resign this circular to give effect to this post-sale discount of not having the conditions to establish the agreements or link it to specify invoices. And it is also recommended that clarification should be provided on these specific scenarios. The three scenarios are non-reversal of ITC on post-sale discount, which are through financial or commercial credit notes. That is, no GST is reduced through such post-sale discount. And treatment of the post-sale discount provided by the manufacturer to the dealer as additional consideration in the transaction between the dealer and the end customer. And treatment of post-sale discount as consideration in lieu of promotional activities that is performed by the dealer. So the council itself has given a recommendation to provide clarification on these three specific issues with regards to post-sale discounts. And next comes the important question. We have seen so many rate reductions in lots of goods and services. Will this be ultimately passed down to the consumer? Initially, we had section 171 of the GST Act, which deal with anti-profiteering provisions of the Act. That is, the benefits of rate reduction will have to be passed on to the end consumers. However, through a notification with effect from 1st April 2025, it was announced that the termination of the acceptance of request by the CCI or the Appellate Tribunal regarding the input tax credit and the pricing impact. That is, the government has stopped taking the acceptance of requests to verify the reduction in ITC and the pricing impact of such tax rates. The government has now, what will happen to the rate reductions that are recommended right now? Will the anti-profiteering mechanisms come back into place? See, one thing to note here is section 171 is not omitted here. It is still in place. It is just that the acceptance to verify all these requests will not be taken anymore. So the section is still in place. We need clarification on this. But currently, the government has said that it expects the business, the trade and industry, to pass the benefit tax rate reductions to the customers, because market competition will enforce them to lower their prices to be competitive, to have a competitive advantage in the market. So what is advisable from the business or the trade and industry's point of view? The businesses are to maintain a proper pricing data to substantiate that they have passed the benefits to the customers. That is, before the rate reduction, this was my price, this was my calculation, and after the reduction, this is going to be my price. Because the trade and industry, to safeguard themselves against the Consumer Protection Act, will have to maintain a robust costing and pricing data to safeguard themselves. And another important query that we've been getting is what happens to the inventory and the MRP on such inventory lying on stock on 22nd September. So goods lying with distributors or dealers or retailers before 22nd September but sold after 22nd September, the GST rate, the reduced GST rate only applies. And what happens if only the old MRP rate was printed on it? We need clarification from the Legal Metrology Act to give us or notify us what to do with the MRP. Initially, when there were rate changes in the early 2017 or 18, the Legal Metrology Act had, by way of notification, given mechanisms to alter the price, or maybe strike or write down the price, or sticker, put an additional sticker on the price. However, with the old prices or old stickers still in place, therefore we have to wait for the CBIC clarification to see how to act on this MRP issue. Now, what happens to the ITC? Let's say the rate reductions. Initially, the ITC was 12%, and no, initially the ITC I had accumulated through 12%, and my outward supply has become 5% right now. What happens to my ITC? My ITC will not be taken back. It will still be available for use, but your working capital may get blocked because your input rate is more than your output rate. So if, however, you have to take note of two things. If your supply becomes exempt in total, your supply was taxable. See, your rate reduction is one thing. It was 12%, it has come down to 5%, but it is still taxable. But if your supply has in total become exempt, your ITC in your electronic credit ledger must be used before 21st September, or else lapsing is required. That is, ITC reversal will have to be done as per the provisions of section 18 subsection 4, which says proportional reversal of ITC on stock, semi-finished and finished goods, and proportionate reversal on capital goods credit. Therefore, this will have to be looked into. And also, wherever the rates have been reduced to 5% without ITC is as good as exempted. That is, you are charging tax, but you can't avail ITC on your outward supplies. Therefore, even on those supplies, your ITC will have to be reversed. Now, the next clarification we need is with respect to inverted duty structure. So, section 54(3) of CGST Act allows refund under inverted duty structure only when input tax rate is higher than output tax rate, and the input and this difference should be due to different goods. That is, the input should be different and the output should be different, not due to rate reduction. So therefore, now if the input taxes, due to lots of rate reductions, the input taxes are higher at 18% and outputs are lower at 5%. This leads to huge ITC accumulation, and we need clarification on how this is going to take place. Lots of working capital is going to get blocked, and lots of ITC is going to get accumulated. And will this price ITC, irrecoverable ITC, will lead to price increase for the customers is to be waited and seen. And also, important point is the inverted duty structure as per circular 135 says that it should be on the input tax rate on inputs being higher than output tax rate on outputs is due to different goods, not on the same good. That is, the input and the output should not be the same good. That is, it should not be due to tax reduction on the same goods. Then inverted duty, refund under inverted duty structure will not be allowed. However, many courts have read down this circular and provided relief to the taxpayers. And if at all there is not any clarification or notification from the government on this, judicial interpretation can be relied upon and can be approached to get inputs on reduction of rate on the same goods. And we will have to see, as we discussed in the trade facilitation measures, we will have to wait and see how efficient the IT systems are and how transparent the risk evaluation systems are, to see if the provisional refund will be granted within 7 days. And we will have to look at it from a practical point of view whenever it is operationalized. And the next important issue is with respect to compensation cess. So many dealers compensation says it ceases from 22nd September 2025 except on these sin goods, and these might go until December 2025. Now, what happens to the unutilized cess credit which is available with the dealers? See, it can be set off with the cess liability till 21st September 2025. If at all it is not set off with the cess liability, see, for compensation cess, it cannot be refunded. It cannot be used for other heads also, IGST, CGST, or SGST. So the only option is going to be that the compensation cess will have to be written off. That is, it will have to be reversed, and which will prove to be an additional burden to the dealers. And we have to wait and see if this burden is passed on to the end consumers. And one important FAQ from the FAQ released by the from the council recommendation is that I have sent my goods by raising an e-way bill and at the old rates. Will I have to cancel and generate fresh e-way bill for the goods in transit when the new rates come into effect? So the FAQ says, as per Rule 138 of the CGST rules, the e-way bill is to be generated before the start of supply or transportation of goods. There is no mandatory requirement for cancellation and fresh generation of e-way bills for goods in transit when the new rates come into effect. E-way bills currently in transit will continue to remain valid as per their original validity period. So there is no requirement for us to cancel the old e-way bill and generate a new e-way bill just due to the implementation of new tax rates for goods in transit. So this is with respect to today's session, and some important FAQs that were discussed as part of our first webinar, that is on 5th September. I'll briefly go over them in the next few slides. Now, how do we get ready for this GST Council recommendation? We will have to do a detailed analysis of all our supply chain details for all our existing contracts with job workers, because there is a rate reduction, rate increase in job workers, job work services. We will have to see what the contracts are saying, if there are recurring contracts, if there are continuous contracts. What is the price stated in such contracts? We will have to change our ERP systems to give effect to new tax rate changes. We will have to prepare revised pricing list based on the reduction in rates or increase in rates, and what is the cost to the company, what is the cost to be passed on to the consumer. And we have to take stock of all goods which is with the dealer or retailer currently, and if it can be disposed of before 21st September, and what will happen if it is not disposed of before 22nd September. And we have to check GST rates for all our inward supplies to decide on the pricings. Also, we have to check the, if at all we have any cess ITC available in our electronic credit ledger, we have to examine the same and see how to go about setting it off with outward liability, or write it off if required. And another important FAQ that was discussed in our last webinar was, if the goods or services or both have been supplied before 22nd September, that is goods supplied before 22nd September, but the invoice is issued and the payment is received after 22nd September, the applicable rate will be the new rate. If the goods were supplied before 22nd, invoice was issued before 22nd, but payment received after 22nd, it is going to be the old rate. And if the goods were issued before 22nd, payment was received before 22nd, but invoice was issued only after 22nd, old rate will still remain in place. Now, if the goods were issued after, goods or services were issued after 22nd, and the invoice and payment were received before 22nd, old rate will be in place. If the goods were supplied and payment received after 22nd, but the invoice was issued well before 22nd, the new rate will still, the new rate will have to be applied for the goods or services. If the goods or services were supplied after 22nd, and the invoice was raised after 22nd, and the payment was made before, the new rate will have to be implemented. We had discussed in detail on the methodology of changing MRP on products. So the legal metrology rule says no wholesaler or retailer can smudge or alter the retail sale price on a pack, or the manufacturer or packer or the importer shall not alter the price on the wrapper once printed and used for packing. This is the rule with regards to MRP that is provided on a package, packed goods or packaged goods. But when as I said, when there were rate changes on certain specified items, permission was granted under Rule 6 of Sub-Rule 3 of the Legal Metrology Rules to affix an additional sticker or stamping or online printing for declaring the reduced MRP. In this case, the old label was also to be continued. So this relaxation was applicable till 31st December 2018. However, we have to wait and see what happens currently to the current price reductions recommended by the council. And anti-profiteering, as we discussed, by notification 19/2024, the government said it appoints the first day of April 2025 to stop accepting any requests for examination as to whether ITC availed by a registered person or the reduction in the tax rate have actually been passed on to the consumer. But we will have to wait and see if the anti-profiteering mechanisms will be revived, since the section is not overall omitted from the act. But right now, the government said it trusts the trade and industry to pass on the benefit. Now, the next question is, my outward supply is exempt under new rate schedule, but I already have ITC of GST paid in my ledger. Will I need to reverse ITC? Till 21st September, you can use the ITC to discharge your outward liability. But from 22nd, if you still have ITC left in your electronic credit ledger and your outward supply has become exempted, you are liable to reverse the ITC as per the provisions of the Act. And will I be eligible to take refund of accumulated credit arising out of inverted duty structure for supplies affected up to the date of effect of revised rate as notified? Okay, the said issue has been clarified by circular number 135, which states that refund of accumulated ITC in terms of section 54 is available where the credit has accumulated on account of rate of inputs being higher than rate of outputs. But then, as we discussed earlier, this should be the input and the output should be different. If it is the same, circular 135 does not allow for refund under inverted duty structure. But also there are various courts which have read down this circular and provided relief to the taxpayers. So that is to be kept in mind while checking your rates for your inputs and outputs due to the recommendations of the GST Council. So we have come to the end of our session. Any queries, please put in the comment section, and you can scan the QR code to keep getting updates on from Zen-Tax Clinic. Thank you. So we have one question where it says, please confirm, is there any changes in the GST rate for HSN code 8437, 8020 and 1000? Sir, you can please refer to the press release or send us a mail which is appearing on the screen. We'll look into it and get back to you. And 40% applicable for which of the automobile product and value of limit of purchase of car value? Sir, 40% is applicable for vehicles which are running on petrol or LPG, CNG, and which is greater than 1200 cc and 4000 mm in length. The specific automobiles, we will have to refer to the press release, sir. So we have to pay RCM at 5% on our lorry freight charges, whether ITC is available or not. Sir, for this, we have to look at the supply of transport of goods by GTA, and it says 5% without ITC is the GTA services. But since you are paying on your lorry freight charges, you can avail ITC, sir. Please share the video recording and PPT after the end of the meeting. Yes, sir, we will upload the video on our YouTube channel and the PPT will be shared. GST rate for textile job work is currently at 5%. What will be the new rate with effect from 22nd? Sir, you can mail this query to our mail ID. We will have to look at it specifically and let you know. Another question is, we are manufacturers of cotton yarn, MMF yarn, blended yarn, and denim fabrics. Now the rates of our major raw materials have been reduced to 5%. We have been claiming IDS refund. Can we continue claiming IDS refund even after 22nd September? Sir, your raw material rates, meaning your inputs, have reduced to 5%. Therefore, your outputs and inputs would be taxed at 5%, meaning there won't be any inverted duty structure. If you still need any clarification, you can send a mail to us. Circular 135 of which year? Sir, Circular 135 of 2020. Circular number 135 /05/2020, dated 31/3/2020. What is the new GST rate for labor charges of heavy steel fabrication? Sir, if it is specifically for heavy steel fabrication, if there are any changes, we will have to look at the press release. However, the residual category for other than the services announced in the recommendations, the rate changes have been from 12% to 18%. If there are any further questions, please reach out to us on the mail or the WhatsApp number or the number available on the screen. Thank you for all your presence in this webinar and for all your participation. Please keep supporting us, and we'll meet you next week with another important topic. Thank you.